I can't believe I'm saying this, but 2023 is pretty much in the books. We're looking forward to 2024. We're going to take a few minutes here and go through 5 real estate predictions that I expect to see in 2024 in the Hoboken real estate market. Now, guys, I don't have a crystal ball, but I do follow things very, very closely. We make videos and we are constantly studying the market of what's going on. So although I don't have, a fortune teller ability here, I do have a pretty good idea of the way things are trending. I have some really good guesses and best ideas of the way we could see things play out in 24. So I'm going to drop them here, and I'm going to continue to update all throughout the year with our market updates and our videos to continue to keep people abreast and adjusted on what's actually happening as the year folds out. Right. So, all right, number one thing, the thing we've been talking about forever, interest rates. Where are they now? Where are they going? Right. So we all know that they peaked all the way up to 8% a few months ago, and they've come down fast and furious into the mid 6s over the last few weeks, which has been awesome. We've seen a lot of buyers and sellers transacting because of that. And I think my best guess is what I could see out there based on economic numbers, inflation, what the Fed is saying. I think we hang out between 6.5 and 7.5, really. I think we will trend slowly, kind of drip towards 6, but I think we're going to live in that 6.5 to 7 range. We might spike up to 7.5 if some weird stuff happens in the world or in the economy, but I really do think 6.5 drifting towards 6 by the end of the year is the best guess of where we see things going next year. We have to keep our eye on a few things. We got to keep our eye on CPI. We got to keep our eye on what the Fed is saying, and also like jobless claims and GDP, what the economy is doing. That's going to affect things as well. And obviously the 10-year Treasury note is going to move off of all those things, which will relate to what mortgage rates do most closely from there. So that's number one. Number two, I think next year more people will decide to sell and list their properties. Obviously, we have a lot of inventory shortages that we're dealing with right now in the market and have been for a couple of years. But I think there's a lot of people that are pent up, that are just fed up with waiting, right? I don't think there's gonna be an explosion of inventory, don't get me wrong, but I do think there's a certain group of people that are just saying, I've been putting this off, I'm waiting, I wanna get another bedroom, I'm looking for a backyard, I'm outgrowing my space, I've been waiting to downsize, like all the different reasons that you want to buy a home. People have just been waiting a year, 2 years, 3 years, some people, to make that move because interest rates and inventory. And I think we're just have some people that just go, that's it. This year, we're getting close enough on rates. They're coming down into the mid to low 6s. We have a 3% mortgage right now. Like whatever. It's not 8. It's not 3 to 8. It's 3 to 6 now. Let's make that move. Another thing is a lot of people in Hoboken at least buy on 5, 7, and 10-year ARMs because they're not planning on staying forever. They're planning on being here for 5 or 10 years. So those ARMs are now getting closer and closer to resetting to market rates. So if you bought, let's say 5 years ago on a 7-year ARM, you only have 2 more years at that 3% rate. So you're going to be at 6, 7, whatever market rate is pretty soon. You might, like, that gap's getting smaller. You can deal with a year or two giving up that good rate and moving into the house that you really want to be in, right? So I think it's really more of an emotional thing. People are just kind of fed up and ready to make the move, and that's going to bring more inventory to the marketplace. Number 3, I think we're going to continue to see rental supply increase. So if you've been following the rental market the last year or so, we've definitely seen a crest and kind of a plateau in rental pricing and rental supply for so long. I mean, it was just like every rental would just go up 5%, 5%, 10%, 5%. I mean, we're up 20, 30% year over year. It felt like every week it was another couple percentage points that we were seeing the market move. That kind of crested 6 months ago, and we're seeing very stable rent market now. We're seeing things, instead of 5 apps in one weekend, it might take a weekend or 2 to get one good app, right? So that's what we're starting to see. I think we can continue to see that and maybe even soften a little bit more for 2 reasons. Most new construction right now, anything outside of like boutique style buildings in the area, right? 2 to 4 units, maybe 6 units. Everything bigger than that are rental buildings right now. And there's supply coming to the market, right? All over. You see Weehawken Cove, there's a bunch of buildings going up Jersey City. Hoboken itself is not too much, but there are a couple that are being built too that are all rental buildings. And we also saw a lot of people when rental rates were rising, they were locking in 2 and 3 year leases. So those people aren't coming back to the market. They're locked in, but we do have some new supply coming to the market, and we have people that are going to move, like we talked about in point 2, right? They're going to move to that house in the suburbs or that bigger home in Hoboken, and they're going to put a lot of them will put their home on the market for rent as well. So we're going to see more supply, but maybe not as much demand on the rental side. Also, rent with interest rates coming down, some of those buyers, let's say 10 or 15% of those renters might say, you know what, it's time to buy because rates came down, even softening the renter pool a little bit more. So that's what I expect to see going into 24, is that rental market continue to kind of plateau, maybe even soften a little bit. Number 4, I think we're going to see prices continue to appreciate. We've seen nothing but year-over-year appreciation. We saw a couple soft spots for a few months where things got a little bit of wonky, a couple price reductions because people were really pushing the issue on pricing, but we never really saw them come down. And I think just given how little supply there is and how many people want to move, I think we continue to see that. The question is how much, right? And I think you can make an argument all the way from the upper range of single digits all the way to the lower range of single digits appreciation this year. So let's just play out a couple scenarios. Let's say interest rates like really kind of trend downwards, right, towards 6, even high 5s by the end of the year. And buyers, I mean, ones that wanted to move are now transacting, but now a whole new another group of buyers come out that couldn't afford it or couldn't make sense of the numbers. Now they can, right? And let's just say sellers don't really react so strongly, saying like, you know what, I'm going to keep my 3% for another year or two. And we don't see as much inventory come to the market. If that plays out that way and buyers really get lit up and sellers, for whatever reason, don't get as inspired, we could see, I think, higher single-digit appreciation next year just based on that out-of-whack supply and demand. Let's say something more in the middle happens where both buyers and sellers do get pretty motivated to make some moves now that rates are down and the economic scenarios kind of are playing out to be a little bit more advantageous to make moves in the real estate market. Then I think we see somewhere in the middle, like 4 to 6% appreciation, maybe right around 5% in a nice balanced market. And let's just say something else happens where rates go back to the moon, right? Buyers get really uninspired to move, but some people still need to list their properties and sell. We might see less demand and a little bit more supply come on the market. It's still hard to see a lot of supply come on in that environment, given so many people are locked into low interest rates. But I think if that scenario does play out, we could see flat, maybe 1 or 2% appreciation in that situation. It's really hard to see a good argument for any kind of decrease in pricing right now, especially in the markets that we work. There's just too much demand at these higher interest rates we've seen all year, and just too few people motivated to sell. So unless that's something like systematically, categorically changes in the marketplace, which there's really, have to be a black swan event, something that really is unforeseen right now, I can't make a strong argument with what we're looking at for prices depreciating at all into next year. Who knows years beyond that? We always see steady trends in the right direction, luckily, in real estate and in the U.S. economy. But that's what we're seeing right now, what's out there. So speaking of trends and cycles, the last number 5 prediction is something I've been talking about a little bit recently in a few other videos, but I think we continue to see this even maybe exaggerate going forward, and that is the move away from the seasonality real estate cycle. Forever, right? We had busy springs, dead summers, busy falls, dead winters by the holidays, right? And it just kind of always cycled. More listings came out, more buyers came out, then they both went away, then they both kind of came back out in the fall, and they both kind of went away. Given what we've been seeing the last 4 or 5 years, we've been seeing things work off of different cycles, and it's becoming more and more dramatic, I think. It used to be COVID, right? So when lockdowns happened or variants spiked or different things like that, we saw people really clam up, go away, not want to transact. And then we saw things loosen up. Variants went down, hospitals issues went down, and we saw people come out, regardless if it was spring, summer, winter, or fall, right? Then COVID, thank God, is a little bit behind us now, and we have this other thing driving the market, which is this crazy, wacky economy and economic data-driven market that we're seeing more. So we saw a super busy July and August, which is usually pretty slow in our area because rates kind of calmed down a little bit. We saw some inventory hit the market. Then the early fall, which is usually super busy, was dead because rates spiked to 8. But now the last few weeks between Thanksgiving and New Year's, which is usually dead, has been super busy. We've been seeing multiple offers, more inventory hit because sellers know that buyers are active again with rates coming down. So we're really in a economics in general, but interest rate driven cycle right now where it's more compelling to work off of what's happening there versus this normal spring, summer. Oh, the weather's getting nice. Let's go buy. No, the weather sucks, but rates just dropped 1.5 points. Let's get out and buy a new house. So I think we continue to see that happening into 2024. Those are my 5 predictions. Like I said, we'll be back here every week, every month, putting videos together, keeping you guys updated on what's actually happening. We'll check back in on this in a few months and see where we went. I'd love to be proven wrong and rates come way down to the floor and everybody's happy and buying and selling and what they want to do and moving into the perfect home for them. That's a great world for everybody, but we'll see what happens. We could have somewhere in the middle. We could have some other crazy thing hit the radar that we're not even thinking about right now. But given where we sit today, that's my predictions. I hope everybody's going to have a fantastic end to 2023. Crush it in 24. Have fun. Enjoy your family. Enjoy all the good times that we have right now. And we'll see you guys in the new year.